owner financing discussion can be found in Chapter 3 of the Farm Transition Workbook. What we'll be looking at here are tools that can be used to facilitate the transfer of assets from the business to one generation to the next. Coverage will basically include the major tax considerations that we have to look at and a few planning pointers that we should consider will also be presented. So, what tools do we have? Probably the most common is installment sales. Basically, an installment sale is you create a sale, there you receive installments over a period of time, that being more than 2 years, more than 1 year, 2 years or more. Basically what it accomplishes, it freezes the value of the parent's estate. How does that work? Basically we set the value at the date of the sale. Any future appreciation in value then accrues to the buyer or essentially the successor. The gain, well, its payments are made, then we recognize the gain. That's when the year is taxable. So it's not full sale, only that portion, that installment that we receive every year that we calculate the gain. The recognition of future gain is limited to the transfer or payments for future years. The payments, that income, not self-employment income. Also, with an installment agreement, the seller can retain a security interest. So if something happens later, default, etc., we'll talk about those. They retain a security interest. They can then be protected. Material participation, remember what that is. Material participation is involvement in the operations, day-to-day business, marketing, etc. An installment sale, material participation is not as the same as in a lease. Whereas in a lease, depending upon what's going on, if there's any type of a crop share arrangement, material participation occurs. With an installment sale, any type of participation is not therefore included as material participation. It's not self-employment income. Disadvantages. Once we set up the sale, we lose a step up in basis. Remember, we froze the value of that property at the sale date. Any future appreciation in value goes to the buyer. Their basis in that property is then what they paid for it, not the value that it would go through an estate. Step up market value, date of death. Payments are missed. There's two things that can happen. One, the original seller has to go through a foreclosure. They also have to then resume management of that business asset. May not be the best thing or what that was trying to occur. If payments are artificially low, it may not provide sufficient income for the seller. Remember, those payments over time will go away. If we set up a 5-year installment agreement, after 5 years, we're done. How we set the terms, the price. Well, if we set the price too high, the buyer's earnings from the property will be less than the payments, and it will be next to impossible for them to continue that operation. If it's too low, bargain purchase, then the transaction trigger both income and gift tax situation. Basically, you're selling the property at a bargain price. Consequently, IRS will look at that kind of disfavorably. The interest rate that applies must be greater than or equal to the IRS approved rate. Those rates are published on a monthly basis, and you can get an idea of what those are by going to the IRS website looking for their approved interest rates. The duration, how long is this thing going to be going on? So the objectives, well, do we want to minimize the down payment or term payments? Is it going to be income for retirement? If it is, we want to probably have a duration a little longer. Do we have a shorter term with a little more security with a balloon at the end to keep the payments lower, but at the end of 5 years, the balloon kicks in and we sell it off? Things to consider. Payment frequency and form. Is it going to be an annual payment, semi-annual payment? How are we going to get it? Cost of the appraisal and closing costs have to be considered. And the big one is, what about default on the buyer? The seller definitely wants to retain a security interest in that property. So if a default occurs, then the seller gets it back. We'll have to go through foreclosure procedures to get it reclaimed. Repossession of that can trigger some tax consequences. That will depend upon the property's value and any gain recognized upon the repossession. So you really got to look at what's going on. Cancellation of an installment debt. Basically, if you cancel that, it's considered a donation or gift. So gift tax treatment can occur for the amount of debt that is forgiven or canceled. Death of the seller during the contract. Think about some options there. Does the contract transferred to the estate at large? Or should it transfer to a trust? Or does the value of that contract transfer to the family members? There are several tax considerations that must be also thought about. An installment sale does not work well with the sale of depreciable assets. Under IRS rules and guidance, when we sell a depreciable asset, depreciation is recaptured in the year of sale, first year of sale, no matter what. So if we're selling a tractor over a 3-year plan, depreciation that has been taken is recaptured in the first year the sale occurs. Whether or not we've received enough payment for that or not, doesn't matter. An installment sale works great with land, raised breeding livestock. These do not have depreciation applied to them. Consequently, it's all capital gain income. There's no adverse tax consequences. We simply recognize the gain and the tax in the year that each payment is received. Basically what it does, it helps reduce the income tax problems by bunching capital gain in 1 year. For example, if we sell a farm outright at an auction and we get $100,000 for that piece of property, the full $100,000, the gain on that is taxable in the year of sale. If we set up that same piece of property, we sell it over an installment contract over 5 years, we'll only have $20,000 coming in each year, and the gain is calculated on that $20,000 each and every year. Consequently, we end up spreading the tax consequences out over a period of time, lowering the overall tax bite. Also, keep in mind, payments, we've got interest, we've got return of original basis, and gain of the sale. So the interest then becomes taxable in year received as ordinary income. Return of basis is not a taxable event. So if you take a piece of property you bought for $100,000, over time you recapture the $100,000 of basis as just that, non-taxable. If the property had increased in value from the $100,000 we paid for it to $200,000, that extra $100,000 of gain is then taxable in each year that we receive an installment payment. There's some other things we've got to watch out for. Related party issues. Related parties are an individual or entity that controls them. For example, if we've got a business entity that's an LLC and we're a partner in that entity and we start selling assets to the LLC, that's a related party transaction. If it's a trust and the taxpayer of any trust and the beneficiary, it's also a related party sale. An executor of an estate and a beneficiary of such estate. So if they are both the same person, they are related parties. Really have to watch what's going on. Related party transactions, from an IRS point of view, do not gain the same tax advantages. Buy-sell agreements. Basically what this does is creates in advance the terms of the sale for corporate or LLC ownership interests. So shares of stock or LLC ownership interests can then be transferred by sale agreement. One person wants in, somebody else wants out. So advantages of this, the owners in a corporation or an owner of an LLC interest, you settle some of the questions up front. Who can buy into the LLC? Who can sell, or what price will they be able to sell for? You get some certainty in ownership at the present time and also in the future. In other words, looking 10 years down the road, who can become the owners? Simply family members? Do the parties that are involved in the operation have to all determine whether or not a buyer is acceptable? Or is there restrictions that will come into play that allow others not to be able to be or to buy in? It makes sure that everybody's interests are on the same page and everybody's aligned with what the original owners want. It also provides an escape hatch if a member wants out. I don't want to be involved in the farm operation anymore. It provides in that buy-sell agreement that I can be bought out at some point at some valuation. Now, these buy-sell agreements can't provide certainty for everything. It's only as good as your what-if thinking. So what if a divorce happens? What if death happens? What if somebody wants to get out? Those are things you've got to think about. But there's always those other hidden things that we've probably not thought about that can occur as well. We've got a grandchild that wants to come in. Have we thought about that? Valuation provisions may not be quite the same or in sync with economic reality. In other words, we use market value, but if you look at income to agriculture, we may not see the same growth in income as we're seeing as inflation on values of the property itself. In other words, the business income is not good enough or large enough to maintain the valuation that would keep up with what other uses of that property might incur. In other words, urban sprawl. Items to consider in your buy-sell agreement. What events triggered the agreement and what should happen in the event of death, disability, termination, marital status change, retirement, deadlocks in decision making. These are some of that what if thinking that you've got to think about. These are some of the main points. And then, should purchases be mandatory or optional on a trigger event? In other words, the buyers or people involved in the business, do they have to buy them out, or can it be an option? Some other things to look at. Do you need a cross-purchase or redemption? And what's a cross-purchase? Basically, that's other owners agree to purchase what's going on. It needs to be looked at. Can an entity, so we decide to redeem it, can the entity agree to purchase my ownership shares, my ownership interest? So cross-purchase, other owners buy out me as another owner, or if it's a redemption, the entity buys out my ownership. What are the issues that impact the design of the agreement? Do we have simply family members, or are there other things going on that we want to consider? So we need to be looking at the agreement, what things go into it, and the benefits that have to be coordinated. For example, deferred compensation. As the outgoing member, do I want to be paid a salary, or do I want to, after so many years, be bought out? Do I want retirement income? Do I need other sources of income, or do I not even care? So benefits have to be coordinated with the buy-sell agreement. What things need to occur, when, where, and how. One other point that we've got to look at is the business valuation. One method of valuing the business is book value. What is its value as an operation on the accounting books for the business? Very high on science. If you go talk to the accounting professors, they say, yes, it's not hard to come up with. There's science to it, not much in the way of art. Basically, if you look at it, value equals shareholder equity. Now, that may or may not be true valuation. It may undervalue the investment assets. There's certain going concern values, and there's some other accounting baggage that goes along with that. So when you start looking at this thing, sit down with the accountant, do some calculations, kind of figure out what the value of the business is from a book value standpoint, and then compare that, work with that on a market value. Now, market value is low on science, but high on art. In other words, we can go out and see what the properties are selling for, but there's more to it, more underlying pieces than just saying, well, property around me is selling for X amount of dollars. We've got to remember, depending on a willing buyer and willing seller, who's going to be buying into the business? Do they want to buy in? A lot of times in small, closely held family businesses, Nobody on the outside wants to buy in. So limited capital from the outside. Basically what we've got to deal with is capital is generated on the inside. What about capitalized value of earnings? What are the earnings of the business? What kind of a period are we looking at? 30, 40 years down the road? If we are looking at a long term, you got to look at a discount rate. In other words, what's the future values brought back to a current market value or current price? That is the discount rate that we have to use to come up with a future value of earnings over a period of time brought back to a current value today. So a review. Basically, these are some tools that can be used to keep the business operating, get the assets transferred to those that we want to have them, those that will operate the business, those are involved in the family day-to-day operations. Also, the business entity discussion. You've got to really review to better evaluate the options that are available. Read closely the material in the manual. Be sure to contact or acquire good, sound business entity advice, legal counsel, talking to your accountant. Make sure your accountant understands business entity accounting. Those are key ingredients to making good, sound decisions on setting up the business entity. Also making sure that the transition goes the way we want it to. So proper legal advice, proper tax advice. Make sure that our goals for the business, as well as personal goals and objectives, are met both now and in the future. Again, for more information, website, go to the Farm Transitions material. Read this and other items that are included in the chapter to get a better handle of what's going on. Thank you.